Welcome back to the training on risk appetite. In the previous sections, we initiated the work on the risk appetite statement by giving you some guidance on how to structure a first meeting of the board and senior management and how to get the discussion around the risk appetite statement started. Now, it's time to look at the right risk metrics for the risk appetite statement. In general, the metrics needs to be clear, relevant, and actionable. Nothing else will help you to get concrete results. So the metrics must be quantifiable so you can actually steer the business. You would like to know how much risk exposure you have. And even more, you also like to know how much a specific transaction will add to the risk exposure. Here, this is quite essential because now you not only use risk appetite for reporting, you also use it for forward-looking steering. Qualitative statements could not provide unambiguous answers. There needs to be quantification. We will not talk about just one metrics, we will talk about multiple factors. The combination of these factors needs to provide a full picture of the institution's risk profile. So we need to look at absolute values and we need to look at relative values. We need to look at credit risk, as well as all the other risks that are prevalent in your institution. We need to look at capital and all the other factors as well. It's also important that we break down these numbers to be more specific for business areas, subsidiaries, so that the actual risk appetite can be used for very specific decisions and also, as we said before, for very specific transactions. So there they need to be useful as a target to be complied with by every business unit. There also needs to be, and this is the final point here, a clear relevance of these factors that we identify. If the risk-weighted assets are the concern or for the measuring of credit risk, the limit needs to look at risk-weighted assets. You need to have as little translation effort as possible between the specific risk that is identified and the measure that is used for the actual limits. The clearer, the more transparent you have it, the simpler it is for your staff, for your employees, for your business areas to understand the information. If it becomes too theoretical, there will be a denial about your risk appetite statement because your staff thinks that this has just been an exercise of some people in the ivory tower of the risk management department and lacks the clear practicability. With this framework in place, let's now look towards the actual set of metrics. We are proposing a risk appetite framework made by the following categories of metrics. These categories will provide a clear target setting. They will support the business activities, and hopefully they will also meet the expectations of all stakeholders. So they will be practical and implementable. The factors, as you can see on the screen, relate to capital adequacy, earnings and earnings variability, liquidity, as well as some business-specific criteria. We think that these factors will together provide a strong control of the business activities and address the key concerns of the various stakeholders, such as, for example, the capital adequacy for the regulators and the earnings variability for the shareholders. As we've discussed in one of the previous videos, the interest of the shareholders is primarily around earnings, and the interest around the regulators is related to compliance with risk limits. The specific criteria that you will select will provide a framework for the set of boundaries for the institution's business activities. And these specific factors need to be developed by your institution and need to be set at levels that are appropriate for your own risk appetite. So let's start with capital adequacy metrics. This is generally a very clear concept, thinking about the amount of risk assets you have in the portfolio relative to your available risk capital. Yet, we can get more specific. There are several categories of capital within the financial institution based on regulatory definitions. For example, they are grouped as Tier 1 and Tier 2 capital following the rules of the Basel Committee. Tier 1 is the most authentic capital as it relates generally to common equity. The assets are equally categorized by the risks, and therefore we look at the classification of such called risk-weighted assets, also sometimes abbreviated as RWA. Some financial institutions have developed more sophisticated measures than required by the regulators under the RWA approach, so that they can better identify the risks of assets. Thereby, they modified the risk-weighted asset calculation. And this is generally fine, we have no problem with that, but you still need to make sure that your regulatory limits are also maintained. As you can see, we have identified two ratios which look at the categorization of capital according to the two tiers, and we relate them to the risk-weighted assets. We have also added a very simple leverage ratio, which covers the total assets relative to the total equity. This last ratio is equally blunt, but also useful, as it is not influenced by any subjective assessment of risk. So we recommend that you include 2 to 3 ratios in the risk appetite framework. One of them should relate to the Tier 1 capital, and the leverage ratio could also be included as it provides a very, let's say, robust approach and direct comparability with competitors, because you cannot analyze the competitors' Tier 1 to risk-weighted asset ratio, as they usually don't publish it. But what they will publish are their financial statements, from which you can derive the ratio of total assets to total equity. Next, let's have a look at the earnings or earnings variability metrics. The simplest form is to look at the return on assets or return on equity, or potentially to be more sophisticated, let's look at the risk-adjusted return on capital, or abbreviated RAROC. We have a separate training course on the calculation of the RAROC. You can look at that, but for now let's assume that we have a general understanding about what the risk-adjusted return on capital means. So next to these quite straightforward calculations of returns, we have a more appropriate metric, such called the earnings at risk, which represent a little bit the volatility of profits. This metric could be assessed using historical data and as well forward-looking assumptions. It is now quite complicated to calculate and potentially quite abstract to communicate this forward-looking ratio of earnings at risks in your organization. So therefore, depending on the level of sophistication of your institution, we would either go for a return on equity or a risk-adjusted return on equity calculation, and only for the more sophisticated ones we would strive for an earnings variability ratio, like earnings at risk ratio, for the earnings category. Next, we look at the liquidity ratios. Liquidity, as you know, is the most lethal risk factor. It is the one that reacts rapidly to a crisis and has been at the core of the recent global financial crisis scenarios. Liquidity needs to be actively managed by the financial institution, and there are several metrics that we can use. Let's have a look at them. For the short-term perspective on liquidity, you could look at ratios like the survival period. This shows you the time horizon that your financial institution can operate with no additional funding available. It's kind of an emergency measure, assuming that on one day the market shuts down and you have no way to access short-term funding. Then the survival period gives you a good indication of how long you can operate. For medium-term liquidity, you can look at something like the cumulative liquidity gaps, which is the ratio of assets and liabilities with an expiry date above 1 year, and you can cluster them into specific categories based on their maturity to better assess the long-term liquidity situation. Naturally, another set of indicators for liquidity which you could include are those that were proposed in the Basel III framework, namely, for example, the liquidity coverage ratio and the net stable funding ratio. They should be part of your risk appetite metrics because particularly regulators are very keen on your compliance. Now, next, let's look at the risk metrics. They can be directly included in the risk appetite framework. In parts, they are already included in the capital adequacy before because they relate to the risk-weighted assets that are put into relationship with the available capital. So we don't need to repeat that risk-weighted asset factor here. We could look at other factors. For example, we can look at concentration metrics, as they are not yet covered in the risk-weighted asset numbers. For example, You can look at the maximum exposure to your 5 or 10 largest customers. You can also include single exposure limits or industry limits. These metrics turn out to be quite robust and not very data demanding. They're also easy to understand from your team. When talking about risks, you should also think about reputational risk factors and include such factors such as customer satisfaction, news coverage, or number of complaints. Of course, you can also be more specific in your ratios and include, for example, a ratio about the number of days it takes you to process a credit file if you are a commercial bank. A key tool for the risk management and the control is stress testing. That provides an assessment of the potential losses and increase of risk in crisis conditions. We have prepared a training on risk management in which we talk about stress testing and how to set up stress tests. We would, however, not include the stress testing in the actual risk appetite statement, but we recommend that you apply these stress tests and these scenario analysis when you develop the actual metrics so that you have comfort that indeed your risk appetite is sufficiently below your risk capacity. Further, we have some business area specific ratios. For example, the maximum amount of exposure for a single product, the maximum amount of liquidity provided by wholesale funding, or the maximum amount of liquidity provided by a single counterparty. So you can see there are a variety of ratios that you can play with and a variety of indicators that are useful for your overall risk appetite setting. In the next slide, we will give you an empty template. You can download that template where you can start developing the metrics for your own institution. Now, with these metrics, we are able to define the risk appetite for the financial institution. This will help our goal to ensure that the financial institution has long-term viability of its business activities and that our long-term goals are not challenged by short-term excessive risk-taking. The risk appetite provides the senior management with an understanding of the risks and business activities, and by that it allows to establish boundaries for business activities to maximize the value within those boundaries. Of course, there is some flexibility to reallocate limits from one area to another if the actual business development suggests so. You need to be flexible. This concludes the video around the risk appetite metrics, and we will continue in the next video with some more guidance on the implementation. We hope you enjoyed the training so far and thank you for your attention. Looking forward to see you in the next video.